could a potential breakthrough in the US and Iran conflict emerge ahead of Friday's nonfarm payrolls report? Well, if so, it could easily reshape inflation expectations, at least in the short term, and influence how markets interpret Friday's jobs data. In this video, I'm going to focus on silver, Euro USD, and USDCHF. So let's have a look at the charts and see whether we can get some direction ahead of non-farm payrolls. So having a look first at silver, well, geopolitics will dominate calendar for commodities later this week. It seems that President Trump has imposed stricter rules on Iran in order to accept temporary peace deal. But given that both Israel and Hezbollah keep exchanging fires in Lebanon, the task for getting a deal this week could be a tough task for both sides. Nevertheless, any encouraging headlines could, of course, support commodities and silver. And in this case, I would like to see a clear close above 80 before I target the 87 resistance, which coincides with this resistance trend line coming from early March. If the price stages a faster rally beyond this boundary, then we could run as high as 92.25, where the extension of this ascending line that connects the highs from April and May is located. Well, if we look at the technical indicators, we can clearly say that we cannot get any clear direction, at least for the time being. The RSI is still below 50. The MACD has yet to enter the positive territory, so we cannot guarantee a bullish action in the short term, while on the downside, sellers will probably need to close below 73 before reaching the 200-day moving average at 67.18. Then if a steeper decline emerges below this threshold, shifting the outlook back to negative, then the 60 number could act as support ahead of the 53.55 level, where the lower band of this potential bearish channel is placed. Now looking at dollar Swiss franc, while this has been also facing stability recently, it managed to start the week on the upside yesterday. But of course, all the attention is on geopolitics as well as on Friday's non-farm payrolls report later this week. Expectations are for a slowdown to 85,000 in new jobs versus 115,000 jobs created in April. So that could be a downgrade from the previous release and a pull back to double-digit numbers. The unemployment rate could remain steady, of course, at 4.3%, and average hourly earnings could also face a slowdown. So overall, if the jobs data meet expectations, that could be a sign that perhaps a rate hike may not be needed later this year. At the moment, futures markets don't expect any rate hikes in the year ahead. We have less than 25 basis points of monetary tightening priced in. So Friday's data might be important in changing pricing in markets. So if we get a stronger than expected report, we could see a rate hike back on the table, and dollar Swiss franc probably running beyond 0.79 to meet the 0.80 level. Then beyond that, a clear close above this territory over here could stage a faster rally up to 81.20 or even up to 82.30, a level last seen back in June 2025. Now, from a technical perspective, well, we don't have any clear bullish signals here as well. Of course, the RSI is above 50, but still it holds a neutral trajectory. The MACD has yet to clearly enter the positive region either, so we cannot confirm a bullish bias in this market either. Perhaps now for sellers, probably the price should break below 0.7760 in order to continue down to 0.7670. Failure to hold here could trigger a straight decline. Probably we could see an instant drop to 0.7602. That's the 15-year low reached in January. And as we can see, the 200-day moving average keeps upside movements in control, so that could be a key level to watch in the very short term. And now looking at euro dollar, we can see a neutral trajectory in this case as well. While Eurozone will be also exposed to geopolitical risks, it seems that Eurozone is facing a cloudy outlook in the year ahead, given the persisting geopolitical uncertainty and the energy crisis in the Middle East. The Eurozone has removed duties on US goods in order to probably keep tensions low with the US, as the economy might face downside pressures in the months ahead if, of course, tensions between the US and Iran remain in play. So euro dollar is not out of the woods as long as it holds below its simple moving averages near 1.1680. Well, I would say that perhaps we need a faster rally above 1.1720 and 1.1750, where the 50% Fibonacci retracement level of this downfall, well, the halfway of this decline is located. So I would like to see a clear move beyond that to target the next barrier near 1.1825, where the 61.8% Fibonacci mark is placed. Now, on the downside, and since we don't have any clear bullish signals here either, and instead we can see that the simple moving averages are already posting negative crosses, that's gonna keep attention to the downside and near the 1.1570 and 1.1590 territory, where the price attempted to pivot a couple of weeks ago. If that floor fails to hold, then we may see an extension towards 1.15, which could confirm this negative pattern, the series of lower highs and lower lows from mid-April, and even lower than the 1.14 and 1.1440 taken from March. That could be the next target on the downside. Well, as regards Eurozone's releases, well, we expect final GDP growth data for the first quarter, final PMI readings, as well as retail sales and producer prices all at the end of this week. Most of them will come out on Thursday and Friday, so those might be also interesting, although the impact could be low on euro dollar, as those are not the first estimates. But yeah, it's going to be an interesting week ahead. Keep a close eye on geopolitical headlines, as well as Friday's nonfarm payrolls report. And of course, we'll be back on Thursday for more technical updates. So stay tuned and we'll see you next time. Bye bye for now.